Federal Reserve Chair Jerome Powell has finally run out of time. The stagflation cycle has shattered the old playbook, leaving the central bank unable to use its traditional tools to stabilize a breaking economy. The primary catalyst arrived in early March 2026, when escalating military hostilities involving the United States, Israel, and Iran forced the total closure of the Strait of Hormuz. That single logistical choke point removed approximately 10 million barrels of oil and liquefied natural gas per day from the global market. In an instant, 20% of the world's energy supply vanished. This chart tracks the resulting violence in the energy markets. Brent crude spiked vertically past $115 a barrel, driving U.S. retail gasoline up 86 cents in less than 30 days. This kinetic shock triggered mechanical cost-push inflation across the entire supply chain. Because energy is a core input for almost every modern product, rising crude prices force production and transportation costs higher, which are then passed directly to the consumer. This external pressure has already leaked into domestic data. Core PCE inflation, the Personal Consumption Expenditures Index used by the Fed to track underlying price trends, has reached a rigid 3.1%. This specific type of sticky inflation is the silent killer of capital bases and purchasing power. Parallel to these rising costs, the labor market has begun to collapse. The February report cited the loss of 92,000 jobs as businesses struggled to absorb the surge in overhead. The U.S. economy is now stranded in a zero-growth equilibrium, caught between a dying job market and rising systemic costs. The March 18th meeting of the Federal Open Market Committee, or FOMC, highlighted a state of unprecedented policy paralysis. Faced with these conflicting forces, the Fed held the benchmark interest rate hostage at 3.50% to 3.75%. This is the official red-lined markup of the FOMC policy statement. The revisions explicitly acknowledge the impact of the Middle East crisis. The committee highlighted their powerlessness with a single sentence: "The implications of developments in the Middle East for the U.S. economy are uncertain." This creates a macro paradox. Normally, 92,000 lost jobs would trigger an immediate rate cut to stimulate the economy, but 3.1% core PCE inflation makes any easing impossible without risking a total currency debasement. This is the updated dot plot, showing where Fed officials expect interest rates to land. Notice this tight cluster of dots. Policymakers are refusing to project meaningful cuts for 2026, keeping the target range near current levels. This chart tracks the change in SOFR implied yields, showing how the bond market destroyed expectations for future rate cuts. Look at the dark blue bars. The exact moment the FOMC announcement dropped, the market instantaneously repriced for a higher rate environment. The highly anticipated 2026 rate cut cycle has completely evaporated. This policy hold occurred despite severe political pressure from the White House and a dissenting vote from Governor Stephen Murin, who preferred a quarter-point cut to support the labor market. Traditional monetary policy is broken. The Fed cannot print its way out of a global oil shortage. While the central bank remains paralyzed, institutional portfolio managers have begun executing a defensive rotation of capital. They are aggressively fleeing the so-called SaaSpocalypse, a fundamental, irreversible structural decay of traditional software and growth equities. Generative AI is now threatening the viability of subscription-based business models, turning former tech leaders into overvalued liabilities. Capital is rapidly exiting these asset-light companies in a search for fundamental resilience. This capital is rotating into neutral assets, stateless, non-sovereign instruments that cannot be debased or frozen by a central authority. In 2026, Bitcoin has officially assumed the role of teenage gold for the institutional elite. As the Fed's playbook fails, the digital gold floor has established itself firmly at the $70,850 level. This institutional rotation represents a calculated attempt to preserve capital within a stagflationary trap. This defensive rotation is quantified by a massive, sudden influx of institutional capital into digital assets during early March. This chart shows the $458 million injected into spot Bitcoin ETFs in a single session. The data proves financial titans are leading the charge. BlackRock's IBIT fund absorbed the majority, registering $263.2 million in inflows. Fidelity's FBTC captured the secondary wave with $94.8 million. These consistent counterparty patterns point to structured sovereign wealth management rather than retail momentum. These regulated instruments allow institutions to gain direct, legally compliant exposure to a neutral asset class. For these large-scale whales, the priority has shifted from seeking speculative gains to ensuring institutional survival. Beyond Wall Street's paper flows, the underlying on-chain data reveals a severe supply imbalance. This chart tracks Bitcoin supply on centralized exchanges, which has plummeted to levels not seen since 2019. Assets are moving off exchanges and into private cold storage, drastically tightening the immediately available float. The strength of this price floor is highlighted by how the market handles massive sovereign sales. The government of Bhutan recently liquidated 58% of its massive 13,000 Bitcoin sovereign stack. Despite this large-scale liquidation, the market absorbed the supply effortlessly without a capitulation event. This constrained sellable supply makes the asset hypersensitive to the massive demand spikes coming from the ETF market. The collision of an aggressively shrinking float and a $458 million demand wall creates a significant asymmetric setup. The macro forces of March 2026 are converging into a single structural squeeze. A paralyzed central bank, trapped by cost-push inflation, is now facing an asset defined by absolute programmatic scarcity. This chart shows the mathematical inevitability of the current trend. Rising institutional demand is meeting a vanishing liquid supply. With exchange supply at a 7-year low, the market spring is coiling. This movement represents a structural exit from fiat currency, an institutional pivot toward non-sovereign assets as a permanent hedge against a failing monetary framework. The Fed is frozen, but the elite are moving. Subscribe to Elite AI Wealth right now for daily market signals before the next breakout.